Hello, business finance students. This is Professor Hassey one last time. You're probably glad to hear those words. Our last online video for this Business 330 class for this spring session. Today, we're going to go over assignment number 4 and just talk about the last task that we have to do to complete your online studies and my responsibilities of getting all those grades and information back to you. So again, today's date is Saturday, May 28th. I am speaking live and in color from cloudy Claremont, California on commencement day at the University of La Verne at 6 p.m. this evening. The College of Business and Public Management will have their commencement, and hopefully I will see many of you next year at our commencement or in years going on. And I think you're all wonderful students, and it's been a real pleasure having you all in this online class this session. So let's take a look at assignment number 4. Remember, we have one more assessment in this class, the final examination. It is due this Sunday, May 29th. You are now working on that, and some of you have already submitted it. But also what I would like you to do this weekend for many of you is go back through your grades, your grade center in Blackboard. Make sure all your grades have been posted. Some of you have some gaps in the assignments, in the work over the course of the session. Make sure if you check in with me, if there's any problems, or if you want to ask some questions about those gaps or ways of fixing those gaps. That's why we had some extra credit questions the last few assignments to help you in your grade for those assignments. So just make sure you take a look at your status of this class heading into this last weekend. The course evaluations will be due and assessed June 1st. Now, again, those are very private. Nobody knows who is giving the evaluations. I just would like everybody to complete those evaluations, and then I will post the grades on Thursday, June 2nd. All right, so let's take a look at assignment number 4. Assignment number 4 was an interesting assignment because we kind of practiced that a little bit in assignment 3, but also I added some twists and turns to it that I wanted to make sure you, as for an assessment vehicle, were able to read and interpret all the information. Now, remember, in this assignment, you're asked to do a weighted average cost of capital analysis and a capital budget analysis using your WACC number as your discount rate to determine net present value and a way of determining whether this project is profitable. One of the key things of doing this assignment is you were given a template. And remember, a template is just a model. It is not the exact answers that you are supposed to do. It's a model of the format of how you complete the work. But in this assignment, there were 2 key areas missing from that template. Number 1 was the weighted average cost of capital calculation, which all of you calculated. The second one was the inflation rate. In the template, I used the same template as in prior working class. The inflation rate was 4%. But if you notice in the assignment, number 4, the expected inflation rate is 3%. And I was hoping you would read the assignment, note that, and adjust your template or your spreadsheet accordingly. And that's what I was looking for as a way of assessing your ability to read the variables, interpret the variables, and put them in a format that gives us the desired results, which is this project, in your interpretation through all the capital budget analysis, worthy, and is it a good project or a profitable project? So again, the key 2 areas of this assignment is calculating the weighted average cost of capital and making sure you have all the variables correctly. I give you in the template, yes, I gave you a lot of the variables, but there was a couple ones that needed to be reviewed and adjusted for your work. So here's the solution file that is also posted to Blackboard. Now remember, As you go forward into your business studies at the University of Laverne, you will be running into classes, especially your capstone class, the last class you will take in your business administration program, where you'll be probably doing this analysis or going to be asked questions about this analysis in this class. So keep this information available to you as you go forward in future classes. The weighted average cost of capital is the cost of money on this given date based on the capital structure and the market rates of this company's present time. Their debt to asset percentage is 65%. Thus, that means their equity percentage has to be 35%. Their company tax rate is 22%. Their interest on their debt is 8.50%. The current risk-free rate in the market today is 3%. The market rate of return is 8%, and the firm's risk beta is 1.4. So if we take those variables, we determine that the after-tax cost of debt is the 8.5% times 1 minus the tax rate of 22%, meaning we deduct, that's a tax deductible information or issue. So their true cost of after tax is not 8.5, but 6.63%. That is weighted by 65% of the capital structure. You get a weighted average cost of debt after taxes of 4.31. Their cost of equity, in other words, what investors expect to return from this company today, based on risk-free rate of 3%, a beta rate of 1 or market return rate of 8, and the firm-specific risk in the market of 1.4 beta. So that formula is the risk-free rate of 3% plus the market premium, which is the market rate of return 8% minus the risk-free rate of 3, so that's 5%, times 1.4 the beta. So 3% plus 5% times 1.4 gives you a 10% cost of equity. That's the expected return today in the market of investors, your cost of equity. That is related to the 35% weighted equity position of the company, and you get 3.5% weighted cost of equity. Add the two together, debt and equity, you get your answer, 7.81%. Notice all these decimals are into the 100th decimal point. 2 points, 2 decimal points. That's what we've required, and we've mentioned that before in the class. So we take that 7.81% and now include it in our 10-year project analysis as our discounted cash flow. There it is right there. So now we take these variables, giving in the assignment, and many were on the template, but again, as I mentioned earlier, the inflation rate was different, and I was hoping you'd pick that up. So we have an investment of $1 million, selling 40,000 units a year at $40 a piece, inflated after year 1 at 3%, and we get that following cash flow stream. At the same time, our variable costs, variable expenses that are on a per unit basis stay the same over the life of the project. 40,000 units selling at a $30 per unit variable cost rate, inflated at 3%, we get that line of expenses. Fixed costs are 175,000, but like any other cost, they are inflated, in this case 3%. They're the fixed costs over 10 years. Our depreciation is given, $1 million over 10 years, $100,000 a year. We get our earnings before taxes, we get our tax rate, and then our net income. This project investment of $1 million is generating an accounting profit of $1.23 million. But as you know, that is not our project cash flow. We have to take into account other cash related items involved in this project. First of all, the salvage value. We are disposing of the asset after its 10-year use at $30,000. Since we fully depreciated the asset, that is considered a capital gain of which we have to pay 22% on. Thus, we net out at $23,400 of additional cash flow in year 10. We add back the depreciation of $100,000 a year since it is a non-cash expense. And then we take into account working capital, which the working capital rate is 10% of the following year revenue. So in year 0, 10% of $1.6 million. We're starting off with an additional cash need of $160,000 in the startup year. And then as revenue changes by the inflation rate every year, we have to adjust the 10% on that delta of the change in sales. And heading up to year 10, when the project is complete and there is no following year revenue, we take 10% of the entire selling amount and we add that as positive cash flow to net out that line to zero of $208,764. So there's our cash flow, roughly an investment of $1,160,000 and a total project cash flow over the 10 years of $2.41 million. We take that year 1 through year 10 cash flow and discount it back at the 7.81% that we calculated as our WACC, and we get a year 0 discounted cash flow of $1,561,769. The net effect of that is a net present value of a strong positive $401,769. Our return in percentage is the internal rate of return, taking year 0 cash going out and years 1 through 10 cash coming in, and defining a return on our investment of 14.17%. The profitability index is the ratio of the discounted cash flow to the overall investment. It's 1.35 times greater than the cost. And we take into account in the straight payback of paying back the $1,160,000, 1, 2, 3, 4, 5.96 years to pay it back. And then I wanted to look for an interpretation in a 1 or 2 sentence of whether you would accept this project with these various returns in dollars, 401,769, in a percent, 14.17, in a profitability ratio, 1.35, and in payback in years, a little bit under 6 years. Most of us and I would agree that the interpretation is we should go with this project. It's a solid enough return. Some people, and I did not have a problem with that, said, no, I would think we would want a higher investment return than 14%, maybe 20 or 25, and then I would reject the project or go back to the drawing board and see if you can squeeze some more cash flow out of this investment. So that's what I was looking for. Basically, the grading was if you missed the inflation rate, you got 10 points taken off. So if you missed the inflation rate of 3%, you went from a 100 to a 90, an A-. If you got additional lines or additional errors, like in salvage value or in the working capital calculation, you had additional points taken off. You had no additional points taken off if you did these incorrectly and these numbers were off, but if you still did the calculations according to their template or the way they are calculated, you got no points taken away. But if you did make an error in the years or how you calculated these, then I did take some points off. And then if you did not interpret or tell me your interpretation of the results, there was about 5 points taken off for that. But the good thing about this project is, yes, you're learning. Yes, you're understanding capital analysis. Yes, you're learning to read and make sure you have all the variables taken care of, but also to allow for this newness of this type of work, I gave you some extra credit points. 20 additional points over 3 questions to add to your grade to help you if you did miss some things. And if you didn't miss those things, you got a lot of extra credit points to help you with your grade point average. And there are the results there. And one of the good things about the extra credit question number 3 is you had to answer this on your final examination by indicating to me the dividends paid by your companies during the course of our session. And if you did provide that information, you can just stick those into your spreadsheet for the final examination question that I ask you about updating your portfolio. So you did a lot of that by if you answered the third extra credit question. So this now, with assignments 3 and 4, give you a solid base of capital budget analysis, which you will use in additional courses going forward into our class. So please keep these templates, keep these solutions, keep these answers. But always remember in the future, make sure as a financial analyst, as a financial manager, you make sure you have a handle on all the variables and the questions that are being asked about those variables and given to you in any project going forward. This format of capital budget analysis is exactly used by major corporations in America and around the world. The thing that's key for the financial analyst and the manager that's calculating this information is making sure you have the variables correct, because they change from case to case, from project to project. And that is a key in your learning assessment going forward, is making sure you understand the variables before you crunch the numbers and put them into your spreadsheet. Very well. So this weekend, you're completing the assessment of this course and completing your work so I can give you your course grade for this course. And I hope one of the things, and I know it's difficult in an online course where the professor's not in front of you, but I think you all have done quite well in assessing the information, understanding the calculations, using the information provided by me, and provide an interpretation of business finance and financial management for your business program. And this final examination covers the last third of the course, asking you questions and answers about and interpretations about these final weeks in regards to capital budgeting, in regards to short-term and long-term planning, cash management, those questions concerning our last part of our course. And remember, as of yesterday, May 27th, at the close of the market, you were asked to determine your ending portfolio valuation, update your spreadsheet, also include the dividends that your company paid during the course of that time, and calculate the return in dollars, in a percent, and in dollars of how your portfolio has changed up or down over these 8 weeks. And then compare that performance to the percentage increases or decreases of the 3 leading market indexes, which you should now be familiar with: the Dow, the S&P 500, and the NASDAQ. And again, all those indexes are defined in the very first few weeks of our course in Blackboard. The final answer is, did you better the markets? Finally, also, the student that has the greatest return, capital gain, positive number, will become our Wolf of Wall Street of our class and will receive a University of Laverne pennant and a star. Oh God, I just had a brain freeze. A Starbucks. There we go, Mr. Hassey. Welcome. Good morning. A Starbucks gift card as a reward for becoming the Wolf of Wall Street. But more importantly, you now have a good idea of how markets work, how you read them, how you interpret them, which will help you going forward in any of your investments and going forward in your future. So with that being said, let's conclude this class and let's move forward into our business studies. As we talked about the very first week in the very first video of our course, this class is for you to learn the value of financial management to how corporations are run, to maximize shareholder value, to using bonds, debt, loans, equity, stocks, investment, to create assets that create and generate cash flow where you can pay off this funding, this capital, and grow the company into the future and pay dividends and reward your investors with that growth. We do this every day in the stock market. We do this every day if you're working for a company, be it a mom and pop store in downtown San Dimas or a major or the largest corporation in the world, currently Apple Computer. If you go to work for Google, if you go to work for Amazon, if you go to work for any corporation, be it public or private in the world, the bottom line of that company is to create value, create profits, create growth. And in this class, we highlighted the definitions of those key areas and how to interpret them, how to analyze them, and how to understand what they are all about. So I hope we've accomplished some of that. And going forward into your future classes in the program, or if you're wrapping up your program, the key thing is to know how this fits into the management of a company, how you use cash flow, interpretation of financial statements, borrowing of money, issuance of stock, how you use that data and information to do marketing, to do human resources, to do technology management, to do distribution and assembly. All these work together to provide a key ingredient in an overall operations of a business. And hopefully this has helped you understand that. And yes, it's been difficult in online, and some of us are not used to it, but I think you all have done very well. And so please, in this last weekend, as you complete your final examination, review your grade situation. If you have any questions or concerns, I'm around all weekend. I'm going to commencement tonight, but I'll be around all day Sunday. Please let me know if you have any questions or want to update anything. And at the same time, I will review your work in this first part of this week, post your grades, and I, again, would appreciate if you would take the time, 5 minutes, to click on the link that's in a variety of different places. That's on the last page of your final examination. It's in your course information area. Click on that link and do your course evaluation. It helps us immensely make a better program, a better College of Business for you and for future students. Your feedback is important. You're our customers. You're our students. Now I'm going to call you colleagues. You've completed your finance requirements. I'm now going to call you a colleague in business. So I want to thank you all for participating, for sticking with me, for giving me your feedback, and working so hard this session. And I hope to see you all live and in color someplace down the road. So for the last time, hooray, this is Professor Hasse. Keep in touch, and I look forward to seeing you all down the road. Have a great summer, stay healthy, and be safe. Adios, everybody.